And now let's bring back Jeff and also our special guest of the day, Dr. Marc Faber. He's an economist and a market forecaster. He's also publisher of the Gloom, Boom, and Doom Report, which is available at gloomboomdoom.com. That one always gets me in the teleprompter. Marc, thanks so much for being back with us on The Income Generation.
Well, thank you very much for having me on your program.
Of course.
Dr. Faber, I have this theory that the Fed has just gone all in with economic, monetary, fiscal stimulus from the congressional side, from the Fed side, to boost up the economy like it's never been boosted before, so they can raise taxes at some point next year, assuming they maintain control of the House. How do you think President Biden's economic policies going forward could impact the markets and the economies?
Well, obviously, the markets are impacted by many different factors, but mostly at the present time by monetary factors. And there's still plenty of liquidity. And people are talking, following last week, about monetary tightening. Well, we have negative real interest rates. In other words, if you take the rate of inflation and the rate of deposit rates, or of the Fed fund rate, we haven't had this negative real interest rate since the 70s. And as you remember, in the 70s, we had accelerating commodity price inflation and wage inflation and so forth. So I think that to talk about monetary tightening at the present time is a very relative expression. And the statements that have come out of the Fed following this kind of hiccup in the market over the last 2 weeks was actually very benign in terms of tightening. They don't intend to increase rates until the end of next year at earliest. And they have plans about employment levels and so forth, which in my opinion would take a long time to be reached.
Well, true. That's Dr. Faber, let me interject for a minute. That's true. But what the Fed is doing is they're feeding this inflation monster, and fear has turned into reality, and things are getting more expensive. Supply lines were hurt. Demand is up. And so are we going to see inflation like we saw in the 70s? Is that possible?
Well, it's possible, maybe even higher. But I don't think it will be lasting. Let's put it this way. If you look at history of inflation, we always have bouts of inflation, and then the price level rises significantly in some cases, but then it moves sideways for a few years and then it goes up again. It's like a staircase going up. And my sense is that we are now in a period where a lot of prices will adjust on the upside, including wages. Whether it will help much is very questionable, in my view.
Yeah, so we're in one of those upward bouts right now, and as opposed to us being worried about the Fed acting too soon and causing a recession, this time the Fed might actually wait too long. But I'd like to change the conversation, because the purpose of our show today is we're talking about retirement income sources. So in this low interest rate environment, how do you tell people who are retired or close to retirement to generate income from their investments who need it?
Yes. I think what I would have told them already 50 years ago is you need to save some money every year and not to overspend. Happiness in life comes on many different levels. Overspending doesn't help. It actually makes people miserable because they have a tough time to repay their loans. So by saving constantly and by diversifying your investments, nobody's smart enough to be at the right time in the meme stocks, and then at another time in gold shares, and a third time in utilities, and then in bonds and so forth, and shift around his money all the time. I think disciplined investment and persistent investment and patient investment is crucial. Yeah. And I think in the market today, you have some hot stocks. Nobody knows what their values will be eventually. And then you have some value stocks. And I think the value stocks are reasonably priced.
Yeah. Yeah. So I would agree. If it's in a time like this, you're going to be in the stock market, stick to value, try to get some yield. And that way there, if things go down before they go up, at least you got your dividend coming out. So Dr. Faber, thanks so much for being back with us here on The Income Generation. It's been our pleasure.
Thank you very much.